Yes, we are live now. Everything is working properly. So, hello students and welcome back to bankexamstudy.com. Let me check if everything is working properly so that we can start the today's session. I guess everything is working properly. My name is Ramandeep Singh and today we are going to do the derivatives chapter. Basically, we are going to do important questions from the derivative chapter. Link to the PDFs are also always available in the description. Please check there. Let me just check, then we can start. Okay. Please follow me on my Telegram channel. Name of my channel is Bank Exams Today. So give me a minute before we can start. If everything is working.
The derivatives chapter.
Yeah, the audio is proper, actually loud. So just a second. Give me a minute. Yep, I have shared it. We are live now. Okay. Let's move on to the question. First question is very easy. Which of them are, derivatives? Basically, I want to explain you the difference between future and the forward, right? The future is basically, this one is very easy. Obviously, I don't want to teach that much only. So, you should know the difference between future and forward, the future and forward contract, right? So, my handwriting is really bad today. So future and forward contract, right? So what is the basic difference and what is the purpose of derivatives? Let's say, I did my MBA, right? So in my MBA, I did my training at Vardhaman Woolen Mills, right? So there are spinning mills, right? They need cotton. Cotton is their raw material. Let's say they need 1000 tons of cotton is their requirement. Currently the price of cotton, in the beginning of the year, let's see, it is rupees 40 per kg. This is the price of cotton per kg in the beginning of year. And at this price, they made agreement. They filled the tenders according to this price, right? But as it is a commodity, the price of cotton goes up and down, up and down. And because the Vardhaman, they are not in a business of speculation. Let's say if the price of cotton goes to rupees 60 per kg, they are not going to make any money. But if the price of cotton goes to rupees 20 per kg, they are gonna make a lot of money. But the Vardhaman, they are not in this business. They don't want to take this risk. So that's why they take help of derivatives, right? Someone else take that risk. Okay, that is the basic point of derivative. That's why people use derivative. Now, what is the difference between future and the forward contract? So what is the difference between future and the forward contract? So a future contract is based on a proper, let's say it is properly organized. It is organized, standardized and standardized. Let's say the lots in the stock market. There are proper stock markets or the commodity markets. Stock or commodity markets are there for them. Commodity markets are there to manage them. They are properly organized, standardized. There are proper laws for that. So that's what a future contract is. There you might have heard about the gold lot. The gold lot is there and all, for all commodities. You want to long or a short a contract, right? So you don't know the buyer, or seller with whom you are actually dealing. If you have ever bought or sold stocks, you actually don't know who's buying when you are selling or buying, whose shares you are buying or whose shares to whom you are selling your shares, because the exchange is between you and the other person. That is future. What is forward? There are two person A, person B, right? They get into a contract. It is not standardized. Okay, the Vardhaman goes to this B trading company and it says, okay, I'll deliver the cotton at rupees 42. 2 rupees is my charge cotton for the whole year. Okay, and I'll supply 1000 tons of cotton at 42 rupees. Vardhaman says okay, but there are problems. Let's say if the price of cotton goes to rupees 80 and this person goes bankrupt, the company B goes bankrupt, what would Vardhaman would do? That may go bankrupt. There is a risk. There is a default risk. Okay, it is not standardized, it is flexible, it is not nothing is organized, nothing is in the future contract, the exchange is there, stock exchange or the commodity exchange is there for your safety. They'll provide you the guarantee, but nobody is there to provide you the guarantee. Okay, so that's the difference between the future and the forward contract. Okay, I hope that I made everything very, very easy. Okay, so the forward contracts, they are also known as over the counter or OTC. I mean, these are the OTC contract. Okay, so let's move forward. If there is any doubt, you can also known as you can ask your doubts. Forward contracts are also known as over the counter or off exchange contract. So is there any doubt in your mind? You can always ask your doubts. Okay, so anybody else? So let's move forward to this is very important question. I'll mark a star here. This is my star question. The price of a future contract at the expiration date of the contract. Give me the correct answer. Now I am giving you like 20 seconds to answer it. Okay, so I guess, see students, in a derivative there is always a underlying asset. What is underlying asset? In this example, the Vardhaman wala example, cotton is the underlying asset. On this asset, the derivative products are made. So underlying asset, it is a base, right? So let's say there is a contract expiring on 31st of March. Let's say 30th of April, right? Because see students, the price of product goes like this. The more the time, right? The more time there is, the more volatility would be there. Okay, right? Give me one answer. The price, what would be the price of dollar to INR? What would be the price of dollar in terms of INR after, let's say, 1 month? But what if I ask you what would be the price after 6 months? This is calculating after 6 months. That would be very difficult because there will be a lot of possibilities. A lot of things can happen, more number of things can happen in 6 months than in 1 month, right? So let's come back to the point. So as we get close to the expiry, the difference between underlying asset and the price and the future contract and the price of future contract, it shrinks, right? It shrinks. So in the previous example, the price of underlying asset, it was 40 per kg, and let's say the forward contract, it was 42 per kg, or the future contract, let's say it's 42 rupee per kg. But as the date gets close, right? As the date is getting closer, let's say the price of underlying cotton is rupees 40 per kg. And let's say after 1 week, what can be the change, right? I mean, if there is a huge gap, that gap would shrink. So at the date, on the same date of the expiration, the price of the future contract would be equal to the underlying asset. In my previous example, that was a cotton. Very easy. What is the disadvantage of a forward contract? I have already explained you in the very first point. There is a default risk, always a default risk. It may be difficult to find a counterparty. I mean, if let's say the Vardhaman, let's say it's A, they need 1,000 tons of cotton, at rupees, let's say whatever the price is, at rupees 42 per kg, right? And the contract expiry is, let's say 31st of March 2021. So maybe it is difficult for them to find somebody like who's ready to take that risk. It's difficult. The exchanges provide the opportunity. It is a market where are a lot of buyers are there, a lot of sellers are there. So it makes it easy. And yes, there is a lack of liquidity, as there is not many buyers or sellers are available, so there is a lack of liquidity. And these, I already told you, the person who buys that, who promises to take that risk, he may default. So all of them are correct. All of them are correct. Okay, so as it is a note, you see all of them are correct. So a long contract requires that investor. Very important. What is a long contract? What is a short contract? Tell me what is a long contract and what is a short contract. Very important. Very, very important. Somebody is asking the difference between paid and the free course. In the free course, I'm doing free quizzes. In the paid course, I'm teaching concepts. In the paid course, there are notes. In the paid course, there is test series and descriptive paper evaluation service, and the paid course is not that expensive. Use the coupon code GURU20. It's worth it. So let's move forward. A long contract requires that investors sell the securities, buy the securities in the future. See, I mean, these, I mean, obviously, let's not confuse you. I don't want to confuse you. These are the only two options. Sell securities in the future, buy securities in the future. What is long contract? What is short contract? Sell the security in future, buy the security in the future. What is long? What is short? Let me tell you. Long is buy in the future, buy the securities in the future. That is, please remember, long contract, right? So what is a long contract? Now what is short? What is short? Short is sell the securities in future. Sell the securities in the future, that is short. Okay. Long means buying in the future. Short means selling in the future. Okay. The advantage of forward contract of a future contract, they are standardized, they are not standardized, they have lower default risk. No, there is a default risk. So a forward contract is flexible. You can, mold the contract, you can change the contract terms according to your, the way you like it, you can change it, right? Let's move forward. Please tell me the question number along with your answers, whatever the answers you're giving. Very important for me. Which of the following is not a derivative instrument? Super easy actually. It shouldn't be there. Future, forward, vanilla swap, butterfly. All of them are actually derivative instrument. So none of them is the correct answer. So vanilla swap and butterfly, advanced option strategies. But anyway, you should know it. Okay. In a forward contract, the party who commits to sell an asset at a specified date in the future. Very important question. I guess I saw this question in RBI grade B. Very, very important. In a forward contract, the party who commits to sell an asset at a specified date in the future takes which position? And the party who commits to buy an asset at a specified date in the future take which position? Very, very important. If you know the answer of question number 7, that means you know a lot. That means you know a lot about derivative. That means you are actually good at derivative. If you know the correct answer, I mean, that means you know a lot. In a forward contract, a party who commits to sell an asset, to sell an asset at a specified date in the future takes which position? If you know the answer, that means you know a lot about it. A party who commits to sell, remember, commits to sell an asset. Please remember this one. What I said, commits to sell. See, commits to sell, it is short. Commits to sell is short. Commits to sell is short. And the party who commits to buy, the commits to buy is long. Okay, so commits to sell is short, commits to buy is long. Short, long. So E is the correct answer. Please remember, commits to sell is short and commits to buy is always long. Okay, please remember that. Please always remember that. Short position, long position. Okay, commits to buy is long, commits to sell is short. Very important. OTC derivatives are generally considered risky. Over the counter products. Why? I mean, again, a repeated question. There is no, again, please remember, there is no exchange involved because there is no formal system. The stock and OTC carry enough reliable information. I mean, see, the stock exchanges, the commodity exchanges, there are proper systems, right? So, that is not available in case of OTC agreement. They do not follow any formal rules. Obviously, the stock exchanges, they make the rules. So all of A, B, and C is correct. Okay. Instrument where different sort of payments are exchanged, very important. As the name suggests, it is obviously not future, not forward, not options, it is swap. As the name suggests, different sort of payments are exchanged. I have already done a proper lecture in my course, the interest rate swap, which is very important topic for SEBI grade A. Please check that lecture. Swap is very important. So if you sold a short future contract, you will hope that interest rates rise, fall, are stable, fluctuate, or any of these. If you sold a future contract, you will hope that interest rate rise, fall, stable, fluctuate, or any of these. Give me the correct answer. Last question, I'm looking for your answer. If you sold a future contract in a hope, if you sold, please remember, you sold a future contract. You didn't buy the short. You sold a future contract. Are you getting it? You sold a future contract. What are you hoping for? So contract sold is of short position. That means you are going to pay the interest rate at fixed constant rate. In the interest rate future, although expectation in the spot market is to increase the rate of interest. So if the interest rate rise, if the interest rates rise, you are gonna make money. If the interest rate rise, you are gonna make money. Are you getting it? You sold a short future contract. Very important. Are you getting I mean, otherwise I can do a full-fledged lecture on this. It is basic. If you are unable to understand this question, I can, I can do a full-fledged lecture for you. I guess I should do a full-fledged lecture on this topic. I'll be doing actually I have already done a full-fledged lecture on this topic in my full course, and the full course is available on bankexamstudy.com. So SEBI Grade A 2020 course by Ramandeep Singh. The video class, if you're unable to understand this, please let me know. If there is any doubt regarding any topic, any question, just let me know. So video lessons for phase 1, phase 2, although the proper lesson, explanation for all these questions are available on bankexamstudy.com. The topics are available there. So it is based on the latest syllabus. The test series is also available for phase 1 and phase 2. So notes are available in downloadable and print friendly format. And I'm also providing the descriptive paper evaluation service. And we got 9 final selection in SEBI Grade A 2018. So just join the course on bankexamstudy.com. All the links are available in the description. 9067201000. That is my WhatsApp number. If there is any doubt, you can always ask your doubts in the WhatsApp. So that's all for today, students. This is a list of students who cracked SEBI Grade A 2018. All of them are our students. I'm really happy for them. RRB Scale 2, Bank of Baroda, Wealth Management, NABARD Grade A. I'm really happy for them. So that's all for today, students. Thank you and have a very nice day. Good night.